Okay guys, so the last thing we're going to look at with regards to making investment decisions and borrowing money is two different formulas. So these two different formulas are on the formula sheet you originally got at the beginning of the course. One is called the gross debt service ratio, and one is the debt to equity ratio. So first of all, when you go and you consider making a purchase for a home, so whether it's a house or a condo, so you'd be taking out a mortgage, the bank has to decide how much of a mortgage you can take out. So not everyone can take out, a huge mortgage for a huge expensive house. There are limits for each person. And so how the bank decides what type of mortgage a person can take out is based on their gross debt service ratio. So it takes into consideration the following calculations. And so when you are looking at houses, they do usually give this information out for the house. So the first thing would be what is the monthly mortgage payment of that house? And we now know using Solver how to calculate monthly mortgage payments. In houses and condominiums, you have to pay property taxes. So that's included in the gross debt service ratio, so how much those monthly property taxes would be. Also, monthly heating costs of the house, so that's like your hydro bill, so heating, air conditioning, that's taken into account. And then if it is a condo, in the gross debt service ratio, there's the 1/2 of the condo fees. Most of the ones we're going to be doing are for houses, so we're not going to be including any kind of condo fees. So you have to add that all together. So make sure in your calculator you put brackets so that adds all together. And then you divide that by the total monthly income of whoever's going to be paying for this house. So whether it's just one person or a couple, then you would add their incomes together. So when you calculate this, it gives you a decimal, and then you need to change the decimal into a percent by multiplying by 100. And then after that, you take that number and you consider, will the bank give the loan or not? So the decision is that house mortgage is accepted if, when you calculate this ratio, the number that comes out is at or below 32%. So the bank will look at that number. If the number that comes out is at or below 32%, so even 31.9, 30.5, 25%, any of those percents, the bank would okay that mortgage. Okay, so let's do a practice question. So it looks like Sandy has a gross salary of $50,000 per year. She wants the bank to give her a mortgage. Her payments are going to be $1,000 per month. The annual property taxes are $2,400 for the year, and the estimated heating costs for the year are $800. So should she expect the bank to give her the mortgage? So these questions require a yes or no answer, and then a statement to back up why the yes or no. So looking at these things, so we're looking at the salary or the income. Now in the gross debt service ratio, everything is per month. So you're going to have to take all of the numbers that aren't represented for a month and change them into a month. So if they were for year, then I'm dividing by 12. So monthly mortgage payment, so MMP, monthly mortgage payment, is already per month, so that's $1,000. Property taxes were $2,400, so I'm going to have to divide those as well by 12. And then last is the heat. And then on that, I need to also get to the month. So I'm going to divide that by 12 as well. Okay, so then looking at all of these values, so 50,000 divided by 12 is $4,166.67. And then the heat is 800 divided by 12. That's $66 a month, 67 cents. Okay, so doing the gross debt service ratio, On the top, I'm adding together the monthly mortgage payment, the property tax, and the heat. So remember, for your calculator, you got to put this in brackets or else it's not going to divide properly. And then we're dividing by the salary and then multiplying by 100. So 1,000 plus 200 plus 66.67 is 1266.67, and then I'm going to divide that by 41.66, and that's going to give me 0.304 00 and so on. So we got to multiply that by 100. So remember, with applied you need 2 decimal places, so just watch that. So I get 30.40%. We have to answer the original question. Will she expect, or should she expect, the bank to give her the mortgage? So remember, it's all about the 32. So the answer to this one would be yes. Now that's not for full marks. You have to say your backup. So yes, it would be because the gross debt service ratio is under, and you have to mention the 32%. Okay, so if it's over, then you would say no, because the gross debt service ratio is over 32%. Okay, the second type of calculation has to do with the debt to equity ratio. The debt to equity ratio is 50% instead of 32%. So basically it compares a person's liabilities, so all the things they owe money on, and it makes a calculation of their net worth, so how much they're worth. So net worth is the measure of the finances of an individual or a company. It's the difference between someone's assets and liabilities. So an asset is anything that's of value that's owned by the company or the person. So something could be like cash, if you have like a bank account with money in it, or cash. If you have any investments, that could be cashed out. If you own any vehicles, or if you own any real estate, or if you have any items that are of value. Liabilities are something a person would owe money on. So it could be a mortgage or a car loan. If you have credit cards where you owe money on them, or student loan owing money on a line of credit, any of those things are liabilities. So to calculate someone's net worth, the calculation is you take all the things they own minus all the things they owe. So own minus owe, and that's going to give us their net worth. So equity in a home is a term used to describe the net worth of the home, the current market value less the remaining mortgage, or the portion of the home that has been paid by the buyer. Since equity and net worth describe the same thing, it's consistent that the debt to equity ratio for a person is the ratio of liabilities without the mortgage and the net worth. So here's the calculation. So you're taking the total liabilities minus the mortgage divided by a person's net worth. So the debt to equity ratio is often represented as a percent, and then we're looking at, is the number below 50% or not for this. Okay, so let's look at an example of this. Okay, so Courtney owns a house at $275,000. She has a mortgage on the property of $240,000. She has a car worth $25,000 and a car loan of $20,000. She also has $12,000 saved in RSPs, and she would like to borrow $7,000 to add a pool to her yard. Will the bank give her a loan based on her debt to equity ratio? So for her debt to equity ratio, we're looking at, on the top of the fraction, her total liabilities. So those are the things she owes money on. So her car loan would be a liability. Her pool money is a liability. Her mortgage is a liability, so she owes this much money on the house. But then the formula says to take off the mortgage, so don't include the mortgage in the top of the fraction. Okay, and then on the bottom of the fraction, we're looking at her net worth, and her net worth is considered your assets. So her assets would be the house, oops. So her house plus her car plus her RSPs, and then minus her liabilities. So her liabilities are her mortgage, her car loan, and then this money for the pool. Okay, so looking at calculating on the top, so I've got 20,000 plus 7,000 plus the 24,000, or sorry, the 240,000. But then I'm taking off the mortgage, so it's not included in the top. So on the top, I'm looking at 27,000 of liabilities excluding the mortgage. And then the bottom, we have her assets, so 275,000 plus 25,000 plus 12,000. And then I'm subtracting from that her mortgage, her car loan, and the pool money. Okay, so that gives us 45,000 on the bottom. Okay, so doing that division, 27,000 divided by 45,000 gives me 0.6, which multiplying it by 100, that is 60%. So then will the bank give her the loan? So the answer would be no, because her debt to equity ratio is above 50%. So it has to be below 50% for the bank to want to loan that money out. So basically with those two types of ratios, when the bank makes those calculations, they're basically saying you don't have enough money coming in that for the rest of all of your expenses to be paid is not really possible. You're going to be like living on too tight of an income. So the bank would then suggest there's some things you could do, right? You could pay off some of your loans. You could make more of an income. You could buy a cheaper house. Like all those kind of things would be suggestions the bank would make instead.